Joining me now is Winnie Chwang, Portfolio Manager at Matthews Asia. She manages the China Small Companies Strategy and co-manages the China and Asia ESG strategies. Winnie, welcome. So first off, how does China stand as an investment environment today?
I think China has been the first one into the whole COVID crisis. And what we've noticed is that China is also sustainably progressing well out of this crisis. From just our underground checks, what we've noticed is that while things are not quite back up to 100%, they're certainly progressing in the right direction. So we've observed that factory operational levels, for example, are back up probably to 95%. There's just a lot more on-the-ground business activity. Meetings are being hosted on site. There's more face-to-face interactions. And in the last week with the Golden Week holiday, there's also been a lot of just increased tourism activity in China as well. So coupled with some of the nuances with regards to the trade war, what we've realized is that there was a lot of uncertainty in the beginning and Chinese corporates were a bit anxious. But with about a year and a half into the whole situation, what we've noticed too is that with or without the trade war, Chinese corporates are pushing ahead and moving forwards. They're actually embracing more local products and services whenever they can. So it's really by no means playing offense. It's really China's means of playing defense, if you will. So all this in line, I think we're cautiously optimistic actually for the outlook and the resiliency of earnings looking ahead in 2021.
And why have Chinese equities proven resilient year to date?
Well, I think, as we mentioned, the COVID crisis containment has actually been a very successful one in China's context. And what we've also noticed is that if you look more deeply at the areas in terms of where performance has come out from in the Chinese equity landscape, it's actually been driven by certain areas of the market. So firstly, I'd say that the A-share market has done very well. And secondly, more broadly across the different sectors, we've noticed that there's been a significant outperformance coming from IT, coming from healthcare, and coming from consumer staples. And there are different reasons for why these areas have actually done well. In the information technology space, what we've found is that they've actually been beneficiaries of the ongoing trade war. So as I mentioned, there's been a huge push in terms of domestic substitution of IT-related hardware and software. So this has provided an opportunity for many, especially smaller IT companies in today's landscape to really be able to grow their businesses quite significantly over time. And I would say that in healthcare, the reason behind that good performance has been related to mostly micro reform agenda that has been ongoing in China. So we see that on one hand, the Chinese government is trying to really clamp down and make generic pricing more affordable for the masses. But on the other hand, they're also trying to spur innovation. And so companies that have been able to demonstrate just high quality R&D capabilities, and also companies who are service companies that are able to facilitate the rise and the growth of R&D expenditures in China, those companies have also benefited quite disproportionately. And lastly, in consumer staples, this has always been viewed more as a defensive area in China. And in the Asia markets context, the consumer staples sector is also home to many of China's best known food and beverage brands, for example. So condiment brands, white liquor brands, as examples, are all available for investable opportunities on the onshore Chinese Asia market. So in more of a volatile trading environment that we've been through, investors have been actually more willing to assign higher premiums and higher PE multiples for consumer staple names. And what we've been cognizant about with regards to the performance has been that while performance has been led by fundamental growth drivers, a lot of that has also stemmed from PE multiple expansion. So we're just a bit more cognizant of that. We'll say that this is not unfamiliar to the Asian market, especially since the retail participation in that market is actually quite high. But I think what that calls out for is the need for an active, seasoned manager to help navigate into some of these more nuanced areas of the A-share market.
And how do you go about finding current and future market leaders in the right place?
Now, in assessing companies, I'd say that investors really need to keep in mind the competitiveness of the landscape in China. So China's just that kind of a place where the infrastructure and the network of say connectivity is actually very good. So it is a market that is set up for perfect competition. So if a business can make a profit today, you'd be sure that in tomorrow's case, there'll be a couple more competitors that are knocking at their doors. So with that in mind, I think what we look out for in businesses is to really ensure that we have access and we are invested in to some of the most competitive players in the investable universe. So you find that in our portfolios, what we notice is what you'll notice is that they are typically companies that fall into one of these four categories. They could be backed by a very, very strong brand. They could be backed by a significant barrier to entry, which often entails a license in needing to operate in a certain industry. They could also be backed by just economies of scale at their back. These are companies that tend to be the lowest cost producer of that mixed widget. And lastly, they could also be backed by very strong and high technological moats. So these are the types of companies that we typically look out for just to ensure the survivability and to ensure that these companies are actually the right ones and the most competitive ones that can actually continue to grow and gain share in China's landscape. Now, let's say that once we've identified this company or these types of businesses, what we then go about doing is going through a more holistic approach in assessing how strong these businesses are. So a lot of our time in research is actually spent on the ground due diligence. So what we do is typically speak with the company, speak with its peers, and also various parts of its supply chain, just to assess what consumers and what customers think about the brand and its value proposition. And this actually very quickly helps us identify just how well a company really stacks up in its whole supply chain. And this rigor is absolutely necessary in China's context. I'd say that it's exhaustive, but it can also be very rewarding because China is an extremely big market. So if you're able to find today's market leaders, you'd be actually rewarded with just that still a huge runway of growth that lies ahead of them.
And looking at risks in China and how to mitigate them, what red flags do you look for?
Certainly. I think the one big risk that I always try to mitigate for is actually that of getting the stocks right in the portfolio. So as I mentioned, China is an extremely competitive landscape. So it's that continuous rigor that really needs to happen in terms of keeping up with the universe, making sure that we actually do get the right stocks in their portfolio. So that's the one key risk on our mind that we really work hard on a day in, day out basis to address. But beyond that, I would say corporate governance risk is the other area that we spend a lot of time and attention on as well.
So, how does corporate governance stack up in China? Are companies willing to listen to investors?
The corporate governance landscape is improving, but the risks are certainly still out there. So we do feel that the prudency of having on-the-ground research is really our first line of defense when it helps us assess, the strength of corporate governance standards across the companies that we invest in. I think corporate governance has certainly improved quite a bit in China's context. In my 16 years of investing in China, I would say that I'm much more comfortable with the corporate governance standard today than I've ever been before. You have to also remember that China is a very deep universe. There are over thousands of companies listed in the exchanges across the multiple different exchanges today. And in many instances, entire supply chains are actually now listed. So if a company is listed, you can almost be sure that its peer is listed, its upstream supplier is listed, and also its downstream customer is also listed and represented on the exchange. So the amount of information coming out of all these companies actually really helps us triangulate just information. And it becomes a lot more difficult for any one particular company to really falsify numbers, because then that wouldn't really make sense across the broader supply chain. And it's really easy to point out any discrepancies from a earnings growth trajectory or that of a return profile. So I'd say that also gives us more comfort in the reliability of the data. Now, when it comes to whether or not companies are willing to listen, I would say yes, but they're also at very early stages. So in many of our interactions on ESG topics, we find that these are still very early day interactions. In many cases in Chinese companies' context, they aren't as aware as foreign companies are in terms of the types of ESG concerns or ESG standards that they're being benchmarked against and benchmarked to. So in many cases, it's quite interesting. A company, as an example, will be rated lowly on social issues. And that may just be because they didn't know or they weren't as aware of the fact that they needed to fill out or to file proper paperwork with regard to labor issues and labor standards and policies. So, you can feel that just the awareness is slowly improving, but we're still at very, very early days. And as more companies are given more interaction opportunities, especially with global investors, I think that there's just a lot of low-hanging fruit. It's simply about filling out that paperwork or establishing that policy that can actually more materially improve their just overall ESG score and profile. So I do expect that over the next few years, and also alongside a lot of government support with regards to improving ESG standards on the ground, I have no doubt that the ESG profile of Chinese corporates will actually be enhanced quite meaningfully.
So finally, talk me through your outlook for the future and indeed priorities.
Yeah, I think our outlook for, especially for 2021, is still very optimistic of China's recovery and China's forward-looking growth prospects. One has to remember that before the COVID crisis, China was actually on really strong footing to deliver another very resilient earnings per share growth story this year. The one other thing that I would also point out too is that China's economy overall has shifted to being one that's very domestically oriented. So if you look at domestic consumption and services today, it actually accounts for the bulk of China's economy. Up to 60% of China's economy is now coming from this part of their economy. So the domestic growth engine is now sizable enough and also a meaningful one that will help China actually grow sustainably into the future. So our outlook on China is still that of one that's very robust, continued earnings growth, coupled with very reasonable and attractive valuation.
Winnie, thank you.
Thank you.